For years, Britain's housing market defied gravity. Prices soared, investors ignored the warnings, and everyone believed property could only ever go up. But in 2025, that illusion is collapsing fast. Mortgage rates are crushing buyers, sales have frozen, and the once safe markets are now cracking wide open. From London's luxury towers to new build estates in the north, prices aren't easing, they're imploding. This isn't a slowdown, it's free fall. Some regions are already seeing drops of 50%, even 80% from their pandemic peaks. And the worst is still to come. Welcome to the UK Dream, where we cut through the hype and reveal the truth behind Britain's housing collapse. Today we're counting down the top 10 UK regions where home prices will drop 50 to 80%, and number 1 will leave you stunned. Stay until the end, because what's happening now could rewrite Britain's property market for a generation. Second home hotspots across Cornwall and Devon are facing their sharpest reality check since the pandemic boom. Local authorities have switched on aggressive second home tax premiums in 2025. Many districts are now charging an extra 100% council tax on furnished properties not used as a main residence. That alone has forced thousands of owners to run new numbers on properties that relied on rosy rental projections and light regulation. Meanwhile, tourism has cooled compared with the 2021 to 2022 staycation spike. Visitor counts and spending in 2024 fell notably, and traders reported softer shoulder seasons, leaving many holiday-let revenues 10 to 15% below owners' expectations into 2025. Pair this with rising insurance and maintenance on coastal stock, and yields are under real pressure. On prices, the headline isn't uniform, but it is sobering. Rural country markets are discount-heavy this autumn. Agents report widespread asking price cuts on coastal and village homes, with Cornish values down around 8% since mid-2022, even after occasional monthly upticks through 2025. The Southwest as a whole saw only marginal year-on-year price growth in mid-2025, far below boom-era gains, and well within the range where heavy discounts can wipe out any paper rise. Liquidity is the tell. More listings linger, chain breaks are common, and cash buyers are dictating terms. Short-let regulations and tax changes have tightened across England and Wales, making it harder to reclassify second homes as businesses. Owners who stretched to buy during the frenzy now face double council tax, softer bookings, and higher running costs. The result on the ground: longer time to sell, more price reductions, and a clear re-rating of premium second home stock across Cornwall and Devon in 2025. Merseyside's headline numbers look strong at first glance. Average Liverpool prices in mid-2025 were up roughly 10% year-on-year, with private rents also posting high single-digit annual growth. That surge reflects pandemic-era affordability, heavy regeneration, a strong student base, and the post-stadium development halo on the wider market. But zoom into the city centre apartment segment and the picture grows more nuanced. Developers continue to bring forward large blocks. New proposals in 2025 include hundreds of additional units within walking distance of the core. Build-to-rent and investor stock have expanded visibility, while letting agents note that top-end asking rents have likely hit affordability ceilings after 3 years of 20% plus cumulative gains. Translation for the next 12 months? Fewer bidding wars, longer voids in some new schemes, and incentives at lease-up, rent-free weeks, furnished offers, to keep occupancy high. For off-plan buyers, tighter mortgage affordability and a higher deposit hurdle have cooled the frenzy, even as select regeneration areas still command interest. The broader northwest shows a mixed tempo, prices stable to modestly rising, but sales velocities slower than the early 2025 bounce, which means the market is more sensitive to price and specification. Investors anchored purely to headline growth risk, missing the shift underneath. Yields on shiny one-beds can compress if service charges rise and rent growth stalls, while family-sized stock outside the core keeps outperforming. The city's fundamentals, universities, culture, affordability, remain supportive. But for 2025, the prudent stance in Liverpool and Merseyside is clear. Underwrite conservatively, expect slower lease-ups on high-density blocks, and price for a market that's still healthy overall, but less forgiving at the city centre premium end. Cardiff enters 2025 with two opposing forces. On one side, a large new-build pipeline is coming. Public-private partnerships alone have green-lit around 2,500 homes across Cardiff and the Vale over the next decade, with additional schemes converting empty offices into housing along the bay and city centre. On the other, household budgets are stretched, and rent inflation has noticeably eased from the 2023 to 2024 highs. Wales house prices in mid-2025 were up only around 2% year-on-year, confirming the grind from higher mortgage costs and slower wage growth. The practical effect: more choice for renters, especially in modern blocks, and tougher competition among landlords to secure longer tenancies. Purpose-built student accommodation, Long Cardiff's safety valve, has pockets of under-occupancy for the first time in years as enrollment growth levels off and supply catches up. In the valleys, affordability still shines versus southern England, but wage growth lags, and higher commuting costs temper demand for premium new builds. Developers are adjusting strategy. Fewer speculative luxury units, more emphasis on mixed tenure and affordable allocations, and sharper incentives on remaining inventory. Letting agents report modest rent reductions or inclusive bills offers on select schemes to stabilize occupancy. For sellers, realistic pricing is moving stock. Aspirational listings are sitting. For landlords, the calculus is shifting to net yield after costs, not headline rent. In short, Cardiff remains resilient, but the easy growth phase is over. Expect flatter rents than 2022 to 2023, longer marketing periods for mid-market apartments, and a steady drip of new homes adding supply into 2026. Value and quality of spec will win. Thin yields on premium stock will be stress-tested as the pipeline materializes. No UK city outside the capital has built apartments at Manchester and Salford's pace, and the numbers prove it. By spring 2025, the conurbation had over 13,000 operational build-to-rent homes and nearly 17,000 more in the pipeline, the largest market of its kind outside London. New consents are still coming through, adding to a multi-year wave of completions around Deansgate, the city core, Salford Quays, and the Ordsall/Trafford fringe. Demand remains robust, but the shape of demand is changing. Hiring in tech, media, and professional services has cooled from 2021 to 2022 peaks, while hybrid work nudges some renters toward outer ring value, larger units in Stockport or Altrincham versus premium micro units in the core. The result in late 2025, sharper concessions at initial lease-up, longer absorption on brand new towers that compete almost entirely on amenities, and more attention to total monthly outgoings as utilities and service charges bite. On prices, official indices still show positive annual house price growth for the Northwest overall, but month-to-month momentum has slowed, and transaction speeds are down versus early year hopes. For landlords who financed during ultra-low rates, refinancing in 2025 means higher debt costs, so even flat rents can erode net yields. The winning formula is shifting to unit mix and spec differentiation. Two beds with workable layouts and energy-efficient fit-outs are clearing faster than top-priced studios. Bottom line, the market isn't breaking, but the saturation point is visible. Expect more rent-free weeks, tactical pricing, and a flight to quality among tenants. Investors should budget for slower lease-ups and tighter margins through 2026, even as the city's long-term fundamentals and regeneration pipeline remain compelling. Glasgow's rental engine has cooled in 2025. Scotland's rent and price growth eased markedly versus 2023 to 2024, and a major policy shift is adding supply back into the long-let market, the nationwide short-term let licensing regime. Since late 2023, hosts have needed a license to operate. By 2024 to 2025, councils were processing large volumes of applications and pushing non-compliant listings out. Net effect: a portion of former holiday lets is returning to standard tenancies, increasing competition for renters in central districts like Merchant City and Finnieston. Incentives that were rare 5 years ago, rent-free weeks, furnished move-ins, have reappeared on selected schemes. Demographics are a mixed signal. Scotland's population hit a record 5.55 million in 2024, but growth is entirely migration-driven as natural change remains negative, an aging profile that can dampen household formation rates over time. With energy, maintenance, and compliance costs rising, net yields are tightening unless landlords can push through efficiency upgrades. Sales volumes reflect caution. Scotland's house price growth in mid-2025 was lower than England's, and transactions are more price-sensitive. Glasgow's student market, traditionally a stabilizer, has steadied rather than surged, and some purpose-built student accommodation blocks report softer re-lets as supply has caught up with demand. The Central Belt still boasts deep strengths: universities, creative industries, connectivity. But 2025 is the year the market switched from momentum to management. Landlords must plan for flatter rent growth, stricter licensing and energy rules, and more choice for tenants. Buyers will find opportunity, but only with realistic underwriting on costs and absorption. The frenzy has faded. Discipline now sets the winners apart. Birmingham and the surrounding Midlands corridor have danced on the cusp of growth for years. Booming abandon, an influx of investment, and a skyline bending upward. But in 2025, the rhythm is changing. While average house prices in Birmingham remain around £232,000, up about 5.6% year-on-year, transaction numbers have halved from 2021 peaks, and new build pipelines threaten to overwhelm the market's capacity. Many city centre luxury flats launched during the boom are now battling rising maintenance costs, high service charges, and a tenant base under mounting pressure. The problem? Too many units chasing too few committed local tenants. Rents remain positive, but growth is uneven and heavily weighted toward prime family homes. Meanwhile, the premium apartment segment is showing signs of softening. Leasing speeds slow, incentives return, and resale values risk being marked down to reflect older buyers' valuations. The West Midlands region is forecast to grow much more modestly in 2025, around 3.5%, compared with the double-digit rises of 2021 to 2022. For landlords and developers who bet on endless increase, the warning signs are clear. Vacancy risk is rising, yields are under pressure, and margins are thinning. Buyers are less willing to pay bite-sized premiums for city centre convenience when commuting is down and home working still thrives. The Midlands still carries strength. Affordability compared with London, solid infrastructure and regeneration projects. But the era of unchecked luxury apartment growth is ending. In 2025, Birmingham and the corridor are at a tipping point. Growth isn't collapsing yet, but the shift from boom to balance has begun in earnest. Leeds and the wider West Yorkshire region were once hailed as a shining example of northern resurgence, but 2025 brings a far less celebratory landscape. Rental listings in West Yorkshire have reportedly surged by more than 70% year-on-year, signaling a supply surge even as tenant demand softens. Purpose-built apartments in Leeds city centre, once snapped up in days, are now competing heavily for new tenants. Wage growth has stalled, inflation stains household budgets, and prospective renters are taking fewer risks. Developers overshot. Thousands of new flats were completed in the boom years, but many are now entering the void absorption phase. Landlords are offering rent-free periods, flexible lease terms, and even deposit waivers just to avoid prolonged vacancies. For investors who bought at peak prices with assumptions of 5 to 7% annual rental growth, the logic is changing. Rising costs, higher finance rates, and a tougher tenant market are squeezing returns. Leeds remains home to strong job sectors, digital, finance, education, but the breadth of the rental market is now under pressure. Postcodes that once enjoyed waiting lists are now hovering with empty units. For buyers and landlords alike, the margins for error are shrinking. In 2025, West Yorkshire isn't collapsing, but it is unmistakably shifting from growth mode into correction mode, and the game is changing fast. The home counties, those commuter belt towns surrounding London, long felt like invincible property turf. High demand, limited supply, strong connectivity. But in 2025, the underpinning assumptions are being challenged. Hybrid working has reduced the daily rush to the capital, travel and living costs have surged, and many buyers are balking at paying premium prices for commute-heavy lifestyles. Listings in Perth, Kent and Berkshire are staying live far longer than they did 2 years ago. New builds commissioned under the assumption of unending premium valuations are now facing supply knock-on, competition from local owners renting out, homeowners delaying move-ups, and finance terms tightening. The townhouse or 4-bed detached that sold in 2022 for £1.2 million might now be re-underwritten with caution, not by what it sold for, but by what a realistic buyer will pay today. Negative equity risk is creeping into some pockets as properties that depended on perpetual growth face correction. The dynamics have shifted. Affordability is stretched, commuting value is re-evaluated, and buyers hold more cards. This doesn't mean a crash yet, but for the home counties, the safety net is gone. The market is moving from confidence to caution, and 2025 could mark the start of a prolonged plateau or gradual decline for once untouchable commuter land. The outer zones of London, once the safe middle ground for growth-hungry investors, are now experiencing an inflection point. Valuations remain sky-high, but rising mortgage rates, higher stamp duty, and a retreat of overseas buying are colliding with affordability limits. Many homes that sold in 2021 to 2022 at peaks are now being relisted after minimal or zero value rise, prompting a rising number of price cuts and changed expectations. The supply-demand equation has shifted. More sellers sitting, fewer buyers stepping forward. The bounce back after 2023's freeze looked promising, but 2025's financial pressure is reintroducing buyer fatigue. Overseas buyers, long a pillar of the London market, are increasingly staying away, uncertain about tax changes, currency risk, and yield margins. For renters, cheaper suburbs and regional centres now rival outer London value. For homeowners and landlords, that means margins are thinner and the assumed upward-only path is broken. The outer suburbs have not yet collapsed, but they are arguably first in line for major price resets if rates stay elevated or inflation persists. In 2025, outer London buyers should be underwriting conservatively, not for growth, but for realistic hold periods and a slower-moving market. At the top of our list sits the epicenter of the correction. Inner London, Zones 1 and 2. Once the bulletproof bastion of global investment, unlimited demand, and premium rents, this market is now leading the retreat. In July 2025, prices in several central boroughs fell around 2.1% month-on-month, one of the steepest drops seen in years. Luxury towers with high service charges, overseas owner dependencies, and short-let overlap are especially exposed. Vacancy rates are rising in top-end new builds as tenants prioritize value and mobility over ultra-premium location. International buyers are pulling back, red tape is increasing, and the layer of domestic demand that can pay high rents or premium prices is thinner. Some tower blocks that sold as safe yield investments in 2021 to 2022 are now reselling at discounts or offering heavy incentives. The consequences? Negative equity risk for leveraged investors, sharply increased hold costs for landlords, and a market where growth assumption has been written off. For buyers and landlords, the message is stark. Inner London is no longer immune. It's not just cooling, it's resetting. What happens here tends to ripple across regional markets and set the tone for the whole country. In 2025, if you're holding, renting, selling, or buying in Zone 1 to 2, you're in the eye of London's property storm. There you have it, the 10 regions where Britain's housing bubble is bursting wide open. Prices that once felt untouchable are crashing back to reality, and the fallout is spreading fast. For buyers, it's a rare moment of opportunity. For landlords and investors, it's a brutal reminder that no market defies gravity forever. The dream of guaranteed property wealth is ending, and the new era of value, caution, and correction has begun. If you found this breakdown eye-opening, hit subscribe, ring the bell, and share this video. The housing reset is here, and the UK dream will be here every step of the way to track its rise, fall, and reckoning.